In 1970, almost every home in America was owned by a person or a family. By 2024, that was no longer a safe assumption. Somewhere between 14 and 16 million single-family homes in the United States are now owned by landlords who rent them out, and a fast-growing share of those landlords are not people at all. They are funds. This is not a story about a housing shortage. It is a story about who gets to own the shortage. For most of the 20th century, the single-family home was structurally unattractive to large investors. Houses are expensive to maintain, scattered across thousands of local markets, and slow to sell. Institutional capital prefers assets that are uniform, liquid, and cheap to manage at scale: office towers, apartment complexes, shopping centers. A single house in a suburb of Phoenix did not fit that model. That changed after 2008. The 2008 financial crisis left roughly 9 million homes in foreclosure. Prices in some markets fell 40% or more. Traditional buyers were sidelined by tighter lending standards, and banks were sitting on a flood of distressed inventory they needed to move quickly. Private equity firms saw an opening the traditional housing market had never offered before: the ability to buy thousands of individual homes at a steep discount in bulk, using cheap post-crisis financing. Blackstone alone spent an estimated $10 billion building a single-family rental portfolio between 2012 and 2018, eventually spinning part of it off into a publicly traded company, Invitation Homes. New technology made this possible at scale for the first time. Firms built software to evaluate rental yield, price-to-rent ratios, and school district quality across tens of thousands of listings simultaneously, turning a fragmented local asset class into something that could be underwritten like a bond portfolio. The structure is straightforward once it is laid out. Large institutional investors, pension funds, insurance companies, sovereign wealth funds allocate capital to private equity vehicles seeking stable, inflation-linked returns. Single-family rentals fit that mandate well. Rents tend to rise with inflation, vacancy in desirable suburbs is historically low, and unlike apartments, tenants in single-family homes tend to stay longer, reducing turnover costs. The fund buys homes, bundles them into a portfolio, and either holds them for rental income or securitizes the rental cash flows into bonds that trade on capital markets, a structure that did not exist for single-family housing before 2013. That securitization step matters, because it means Wall Street is not just buying houses. It is packaging the rent from those houses into tradable financial products. Estimates vary, but institutional investors, defined broadly as entities owning 1,000 or more single-family rental, are generally estimated to control somewhere between 3 and 5% of the single-family rental market nationally. That is a minority share of the overall housing stock. In most of the country, this trend is a rounding error, not a takeover, but national averages hide the concentration. In specific metro areas, Atlanta, Phoenix, Charlotte, parts of Texas, institutional buyers have at times accounted for 20 to 30% of home purchases in a given quarter, concentrated heavily in the entry-level price tier. That is the segment of the market first-time buyers depend on most, which is why the trend draws outsized attention relative to its national footprint. It is worth naming the other forces at work in the same period because institutional ownership is one factor among several. Zoning restrictions that limit new construction, elevated mortgage rates following the 2022 tightening cycle, and a persistent multi-decade underbuilding of starter homes have all compounded to constrain supply well beyond what institutional buying alone can explain. Several state legislatures have introduced bills restricting bulk institutional home purchases, following the lead of jurisdictions that have already capped ownership thresholds. Whether these measures meaningfully slow institutional buying remains an open question. Enforcement and definitions of institutional vary widely between proposals, and some firms have adjusted by shifting toward build-to-rent developments instead of buying existing homes, which does not fall under most of the proposed restrictions. Build-to-rent is worth watching closely. Rather than buying existing homes and competing with traditional buyers, developers are now constructing entire subdivisions explicitly designed to be rented, never sold. Analysts tracking this segment estimate it has grown from a negligible share of new construction a decade ago to a meaningful portion of new single-family starts in some Sunbelt markets today. If that trend continues, the debate shifts from who is buying existing homes to whether new homes are being built to be owned at all. None of this means the traditional path to homeownership has disappeared. Most homes in America are still bought and sold the way they always have been, between individual buyers and sellers, financed with a conventional mortgage. But the entry-level segment of the market, the segment that determines who gets a foothold, is where this shift is concentrated, and it is worth watching closely as the data continues to come in. The market rewards patience, it punishes noise, choose accordingly.